Hello and welcome to our global investment outlook for 2020. Will the world economy recover from the trade shock? We believe it will, but only slowly, as the hangover from the trade war lingers. Now there is some good news though. Indicators of global activity have started to bottom out, a recession has been avoided, and monetary conditions should remain supportive. The risk of a no-deal Brexit has also receded, so optimism is rising in trade talks, and here we see two possible outcomes. Now the most likely is a temporary truce between the US and China that will improve trade flows but leave much uncertainty. Or a less likely scenario is a game-changing deal rolling back existing tariffs and removing the threat of new ones that would bring substantial benefits across economies. Meanwhile, China will continue to manage the slowdown of its maturing economy, and emerging markets should slowly recover thanks to the recent wave of rate cuts and the temporary US-China trade reprieve. In Europe, all eyes are on Germany if finally the region's largest economy shakes off its aversion to debt with a fiscal package. The Eurozone's fortune could improve greatly. Overall, the road from here will largely depend on the trade talks. Current progress is only a first step in what should be a long process. Meanwhile, the US election will take center stage. So, where does all this leave investors and how should they position their portfolios in this slow growth, low rate environment? Well, let me turn to Stéphane.
2019 offered exceptional returns, helped by attractive early year valuations and monetary easing. But it has not all been plain sailing. The geopolitics of trade and Brexit have taken markets on a volatile ride. In 2020, performances in the low single digits are more likely. As Sami just said, accommodative central banks will keep yields low, and persistently low yields in traditional fixed income represent a major hurdle for many investors. The stakes are particularly high for pension funds and insurance companies, as they may find it difficult to meet their obligations. For our private clients, this is also strategic. We want to position their portfolios to benefit from carry strategies, which means preferring investment in higher rather than lower yielding assets. We see emerging market debt, global high yield, real estate, and infrastructure as exposures where investors can find the best risk-adjusted returns. This needs to be balanced with a cautious equities positioning. Growth will be weak but positive, which should support some earnings growth. Some inevitable surprises will also test our asset allocation, which is why gold and protective put option strategies will remain necessary. In currencies, we are long sterling and we expect emerging market currencies to see some upside, while the US dollar should trend lower. The US election and the trade dynamics will, of course, be key to investor sentiment. But the unpredictable nature of US politics and volatile trade negotiation are only two reasons for caution. The cycle's remarkable longevity, expensive asset valuation, and other geopolitical threats, including rising inequality across the globe, are all good reasons to keep a resilient portfolio positioning. We will stay agile and use volatility episodes to adjust our risk exposures as events unfold. As we prepare for the challenges ahead, we wish you all a healthy, happy, and prosperous 2020. Thank you very much for watching.